Welcome back to another episode, and we're going to deep dive on investing in notes. And I was telling our guest today that I've taken some classes. I've really always in the back of my mind wanted to become a note investor, and I just like never took the plunge because I feel like kind of lost. I've done a lot of real estate transactions, flipped homes, buy rental properties, finance a lot of, you know, over my 25-year lending career, I've done, thousands of loans, but never really got on the note side. So today's conversation is going to be geared towards, diversifying your portfolio, what is available to new note investors, how to look at deals, where to find deals, and everything, how you can use self-directed vehicles to invest in notes, and what kind of opportunities are out there. So please welcome Fred Moskowitz to the show. Fred is an experienced speaker, author, and educator. He is known as the alternative investment expert. He just recently wrote a book called The Little Green Book of Note Investing. Welcome to the show.
Thank you, Beau. It's great to be here.
All right. So let's just dive in. Let's go meat and potatoes on this conversation today.
Yeah.
What got you started in note investing?
Well, I'll tell you, I started out like a lot of people do that are interested in alternative investments and cash flow. I got into real estate, started acquiring properties, building up a rental portfolio. And through that, and my education in the real estate space, a lot of times some of the books I had would really touch upon the idea and the concept and strategy of either buying a property with owner financing or selling a property with owner financing and originating a note. And I thought that was a really intriguing avenue. And through my real estate education, I was fortunate to attend workshops by some of these old time guys that had a lot of experience with note investing. You may be familiar with Peter Fortunato and Jimmy Napier. I mean, these are old school real estate investors. And I'll never forget, I was sitting in a workshop about negotiation being taught by Jimmy Napier. And he's well known for note investing, but in this case, he was just teaching about negotiating, how to negotiate when you're buying a property or any life situation. But one thing that I'll never forget was he started talking about the idea of note investing, and that if you own property long term, it's a great vehicle to build wealth when you're first getting started and you don't have a lot of money to put down. You can buy and hold a property. But once you build up that profit, that equity, if you're able to take that out of the property and then reinvest it into debt, you could earn such a higher rate of return. And that's the place he was coming from. And Jimmy Napier is really known as the grandfather of note investing. He wrote this wonderful book called Investing in Debt. And that's really what got me interested, because when I learned about this concept, I saw that it was something that I could really grow and scale into something big. And a number of years later, I had opportunity through some relationships to buy some notes, buying notes that already existed. I didn't have to originate them. They already had a track record. They were set up. And so when I saw that opportunity, I was very interested. And that's how I got started many years ago.
Thank you for sharing. So let's kind of unpack this a little bit. Let's so when you first got started in note investing, you went and purchased a seasoned note, meaning it was maybe seasoned for 6 months or 12 months. It was probably with a third-party servicing company. And
Exactly.
essentially, let's walk me through what we're looking for in a note. Like, let's say we don't want to do anything. There's a lot of techniques we talked about a little bit before we went live here on advanced strategies. Let's just talk
Yeah.
about the fundamentals of like your first couple deals.
Yeah.
So just talk
So,
us through what to
yeah.
look at. Yeah.
First couple deals, what was it that I was looking at? So these were residential mortgage notes. And one thing to keep in mind is that as note investors, we can buy nationwide. It doesn't have to be that we're near the property. Actually, of all the notes I've owned, never set foot near a property, um, because they're located everywhere. And so that gives you a lot of flexibility geographically, and expands the potential deals that you can look at. So what are you looking at when you're evaluating a note? And this is something I cover extensively in my book. Some of the aspects to look at are, of course, the property, which is the collateral backing the note. And so you're going to look at the value of the property and how much equity there is and what liens are there. So you can see, is there a good equity coverage above your loan that you're buying? Sometimes there's not, and that's okay, but that does impact the risk. It impacts the pricing as well, because like any investment, the more risk you're willing to take on, you can get a better discount and receive a higher rate of return. And so that's something to keep in mind. So we look at the property, at the collateral itself, and then the track record. What's the history of the borrower? Have they made all payments on time for years and years and years? And that's the track record. Or is it a borrower that they've had some bumps in the road, maybe got behind, but then got caught up, or there's some missed payments here and there? Sometimes we see that a lot with people that are employed through seasonal work, where they'll have certain months of the year where their income is very high and they're bringing in a lot of cash flow, and then other months where they get behind. And each year you see that recurring pattern. And so, again, the borrower profile, you're underwriting that borrower the same way that a lender is underwriting a borrower if they were writing a new loan. And so you look at that, you look at their credit history, their debts, and their general track record. Now, going beyond that, servicing records is very important to see. What it gives you a picture of what has happened in the past, as well as looking at the reputation of the note seller. This is something that's so important, and I feel it's often overlooked. When you're doing a deal and buying a note, you want to know who you're doing business with. Are you doing business with someone that's reputable, someone that's going to deliver as promised and do everything they said they're going to do? And what's really important to know is, how does someone behave when there's a problem, when things go wrong? And by the way, that works both ways. A note seller, is probably going to be doing the same to you as a buyer to qualify you, because they don't want to waste their time with someone that is not serious and doesn't have a good track record. So those are some of the important things to look at right off the bat.
Okay, so let's kind of break this down now. So let's just say somebody sent you an opportunity. Maybe the first thing you would do is you'd Google the property just to get kind of an idea of where it is, look at Zillow, and just what's the collateral, right? What is
Yep.
the underlying collateral? And Zillow might say it's a house worth $150,000, let's just say. Then you're looking at the loan amount, right? What's the loan amount? And that might be $85,000. And then in this collateral package you have, then you're looking at how many payments have been made with this particular servicer, probably, that you're going to be purchasing the. Usually you're probably buying it, if you're buying a season note, it's going to be with a third party servicer that you might have a relationship with.
Yeah, or not. It's okay. That it's important that it's being serviced by a servicer. Sometimes you'll come across notes where there's no servicer in place, and that adds another level of challenges. I, as a business practice, we have our loans serviced by a servicer. In some states, it's actually required, but it really makes life easier to have it, especially when it comes to producing records,
Mm.
payment history, and those things. And so, yeah, we would look at what's provided by the servicer, and it doesn't matter if it's a servicer you have a relationship with or not. It's going to be pretty standardized according to industry standards.
And then so you're getting the original loan documents too for review, right? Because you want to
Yes.
see how this loan was originated. Was it originated correctly? So you need to know the diligence process on these legal documents. Make sure everything was recorded properly. The loan documents are valid. There's no errors. Is there third party companies that actually will kind of vet those out for you and make sure there's nothing wrong? I mean, how are we looking at this when we're making
Yeah,
a
there's some different strategies to do that. So there are document storage companies that specialize in mortgage notes. They're not going to analyze what's in the documents. They're going to analyze that everything's in the file, and is anything not there. And if you have a very large portfolio, let's say you're taking down hundreds of notes in a purchase, that's probably a good idea. But if you want to look into the loan documents themselves, hire an attorney, hire your attorney that you work with in that state. They can do this in under an hour of their time. Pay them for an hour of their time to go over the documents. They will identify that everything is valid. If there's any issues, sometimes you could be buying a note that you can't enforce in that state for one reason or another, and so they will. Those are some of the things they'll check for. So yeah, an attorney is a valuable member of your team, and it does need to be an attorney that's licensed in the state where the note is. That's important.
And that brings up another question. I think certain states are probably more advantageous to own notes in than other states due to, whether it's a judicial state, right, or a trustee state where you can
Yes.
foreclose easy. Like, what have you found the most? What states do you prefer to make your investments in, if any?
Well, we buy nationwide, and so we're buying mixed pools of loans. So there's no preference at all. We'll see some adjustments in pricing, and there's definitely investors that have their preferences. Some prefer to buy only in deed of trust states, which are the non-judicial. Um, but there's no right or wrong answer. But from my view, we go for diversification in the portfolio. And so that means buying nationwide.
What about Fred? Like, most people don't have hundreds of thousands; they might have 100 or 200 grand to start with.
Mhm.
I mean, what's your advice there to like get started?
Yeah, that's a great question. So getting started, there's a few different approaches to this. You can go out and it really comes down to how much time do you have? How involved do you want to be? Do you want to be an active investor or passive? And so if you want to be an active investor, go out and buy some notes. I would say spread your capital among a few different notes, a few smaller ones is better for diversification purposes. If you choose to be a passive investor, you can invest in a note fund. And what a note fund is where the fund manager goes out with an offering, raises capital, they pool that capital together, and then go out to the secondary market and buy notes in bulk quantity. Some of the advantages here are that the fund manager has relationships in place already to have access to notes. They're buying in bulk, so they can negotiate a better discount, which means a higher rate of return. And also it gives diversification for the investor because their capital can be spread out among hundreds of notes or maybe thousands of notes in a large fund. And so those are some of the different approaches. And really it comes down to, for each individual, figure out what's right for you. What's right for your situation? How involved do you want to be? If you're a busy professional or a busy business owner focused on growing your business, you're probably not going to be hands-on with note investing. And so in that case, investing in a note fund is a great option. Now, if you have a lot of time and you're wanting to really learn the business and be involved, then absolutely go out and buy individual notes and get started. It is a business that you learn by doing, learn by being hands-on.
So, what kind of range is like if you're fairly not, if you don't have too much capital, you probably want to invest in areas where there might be smaller loan amounts, unpaid principal balances, right? Like where your dollar you could go and, like, if I had 100 grand to invest, I wouldn't want to put it in one
Right.
note because the risk level. I want to maybe get four. What are the
Exactly.
strategies as you're getting started to kind of break your way in?
Yeah, some different strategies are you can look at buying junior liens where you're in second position. You can get a better value for your four $25,000 notes on better quality properties. And it's a great way to get diversified. Other strategies can be things like investing in partials where you're buying a part of a note instead of a 30-year payment stream on a note. You could buy a partial where you're buying 5 years of that or 10 years of that. And those are some of the more advanced, more complex strategies. But for some investors, it works out really well. And I like that. I like those strategies. But I love what you said about, instead of buying one note with your $100,000, buy four notes. And that is exactly the name of the game. In insurance companies, how do they operate? Think about this, Beau. Insurance companies go out and write policies. They're not going to insure one person or one property. They're going to go insure a whole pool of properties or people or autos. They write all the policies with the idea that, yeah, there'll be some claims to pay out here and there, but the likelihood of all of the policies going for a claim at the same time, highly unlikely. Not impossible, but highly unlikely. And so this is really taking a page from the playbook of insurance companies. And let's face it, insurance companies, they've been in business for hundreds of years. They know what they're doing. And so why not learn some of their strategies and utilize it to our advantage?
So as you were growing, it sounded like when you got into the note business, you had a decent portfolio at that time, so you had some money.
Yes.
But how have you been able to scale up? Did you start your own fund, or were you selling off partials? I mean, like, if you have a certain amount of, it seems like you could quickly run out of money unless you have really good strategies. The reason I'd
Yeah.
like to do real estate is I can leverage. I can go, and
Yes.
this is why I know there's strategies to do this, but this has been my, I'm being transparent with everybody. It's been my frustration with notes is that I just haven't learned. Like in real estate, for example, I could buy a house that needs work. I can go get a hard money loan for 90% of the purchase, 100% of the repair costs. I come in with 10%. I can even borrow that, right? Like I can leverage, and I want to
Yes.
leverage the note business, and it takes a little bit more because it's right.
Yeah.
And so that's when we get into these advanced strategies. Can you just walk us through like a deal that you've closed where you've used very little of your own money and it was a success?
Yeah, no, I will completely agree with you. You can't really use leverage to buy notes. The reason is notes are purchased as a cash transaction. You're buying a payment stream. And so the strategy is you need to come up with capital from somewhere else, either from another asset that you can leverage or some other business activity. I love the strategy of utilizing retirement account capital. If you have a self-directed IRA or 401k that's self-directed, great source of capital, and putting that to the highest and best use. Um, strategies with no money or little money down, that's definitely not realistic. You do need to leverage other assets that you have or raise capital from investors, which involves setting up a fund or selling a partial. There's some different ways to go about that, but and they can work very well, but it does add another level of complexity and overhead to your business for
But
sure.
hypothetically, let's just say I became good at uncovering really nice deals, nice
Mm.
notes, because just like there's these good deals just in like buying real estate. There's sometimes you fall onto good deals, and so like if you have other people's retirement accounts, for example, right, that they want to do deals with you,
Yeah,
you could potentially find the note, sell off the first X amount of payments, which basically covers what you paid for the note, and then you just get the tail end, right? I mean, there are ways of
absolutely.
doing this. I mean, I've heard, like Quincy Long. I don't know if you know Quincy.
Yeah,
Yeah,
from Quest.
yeah. Like so, that's what really intrigued me.
Hmm.
Um, but so there are ways of being creative and leveraging it, of at some sort. So like
Absolutely.
there's OPM, other people's money, or OPR, other people's retirement. I just coined that, OPR, other people's retirement account.
Yeah,
Um,
retirement accounts are really powerful for this strategy. I'll tell you why, Bo. Um, One of the things about note investing is it is an activity that generates a lot of tax liability, and there's no way around that. Um, it's not like real estate where you have deductions and depreciation and all that. With note investing, you end up with capital gains and interest income. And so you're paying taxes on that. And so if you can do note investing out of a self-directed tax advantage account, like an IRA or a 401k, or even better, a Roth, this becomes really powerful because everything is subject to the preferential tax treatment. And when you are able to cycle your capital and do deals without being subject to taxes, the rate of growth is astronomical. It's very powerful. And so, whenever I'm speaking with investors that are getting involved in note investing, I always ask them, are you doing this out of your retirement account? And a lot of times they say, hey, Fred, I didn't even know you could do that. And so then we have a different conversation and I explain to them some of those strategies because it is really powerful. And it's something that I always encourage everyone to look into.
Hi, this is Beau, host of the Investor Financing Podcast. I appreciate you checking out our channel. On this podcast, we talk about real estate, investing, financing, business lending, and acquiring and expanding your business. I'm sure you will find some videos here that will help you build your business empire. There's a lot to see. Take your time and make sure you comment, like, and subscribe. Thanks again.
let's just say my aunt has some kind of self-directed vehicle, okay?
Mhm.
And she doesn't want to get involved, and so I basically want to use her capital, and I want to make a spread, right? Like, and
Yes.
that's in a strategy where I'm leveraging, isn't it? So my aunt's like, hey, my money, well, we're saying it's in a retirement account, so she's self-directed retirement account. I buy this note for 50 grand. I use her 50 grand, and then there's ways to structure it. I'm guessing that, like, I can give her a nominal rate, and then can you actually wrap these, or what would be some strategies using OPM like this?
Yeah, you can do a wrap like you're suggesting. That's more complicated than it needs to be. I prefer using a partial where you, let's say you buy the note and then you can sell a partial to your aunt, your family member, as long as it's not a prohibited transaction, of course.
Oh yeah, yeah,
But but you can, or let's say you did it with a buddy of
yeah,
yours,
buddy.
right? That's not a family member.
I
Yeah,
shouldn't used an ant. Okay,
a friend.
right.
And so, and for all of us investors, it's important to have financial friends because you do deals with each other. And this is the perfect example. You buy a note, let's say there's 100 payments, and then you sell a partial for 60 payments, and you recoup your outlay of capital, but now you got your money back, and you can keep the back end of those payments. And if it's in your retirement account, it's nice because you don't care. Those payments aren't going to come for 10 years down the road when maybe, but you don't care because you don't need that money now anyway. And so you can keep growing and building up these assets, which are back ends of different notes, the tails. That's what they're called in the business. And so there's a lot of creative ways to structure that, and it can be very powerful. The main thing I would say, if you're looking at this kind of strategy, is set up the note with a servicer that's good at handling partials. Some are really good at it, and that's where you want to have your notes serviced, because they'll handle the whole transaction, and especially the shift over when the partial ends and then it reverts to the back end of the payments. They take care of all of that. And so I like to always leverage the servicer because they're set up for it to keep everything compliant and do a lot of the heavy lifting for you.
So now are you pretty much all note investing and no real estate? Are you still buying real estate, or what does that look like for you?
No, it's a mix of real estate. I love real estate, especially because of the tax advantages. But my main efforts are on note investing for sure.
What were you doing prior to getting into real estate?
Prior to getting into investing, I came from a long, successful career working as a computer engineer. And Beau, I spent many years working at technology and startup companies. And what happened was I watched my entire industry get flipped upside down during the bursting of the dot-com bubble. And then we had the September 11th attacks. And those events just made me realize that I was way too dependent on the income from my job because it was my only income source. And so I came to the realization that no matter how talented of an engineer I was or how valuable of an employee I was, if things were not going well in the industry, I could quickly lose my job through no fault of my own. And so that really is what inspired me to start learning about investing in a way that builds cash flow and income. Because the best thing about investing and buying and building assets is that you get paid while you wait. And that's a huge advantage.
Yeah, that is. And what kind of real estate investing, when you do real estate investing, what do you like to invest in on that side?
Oh, it's pretty diverse. I like diversification, single family properties, multifamily. I like investing in apartment deals and
As an LP, mostly?
No, yeah, exactly. As an LP, where someone else has the expertise to operate a 500 unit apartment building, and I leave that to them. The same way with a note fund, right? The fund manager has the expertise and the experience to manage and build a portfolio.
Sorry, I forgot if you said, do you have a fund now, or is that something in the future for you?
No, we have a fund.
Okay.
Yeah, but it's a great option. There's a lot of different funds out there, with different business models. Some funds exist for doing hard money loans, those fix and flip loans. Mm-hmm. Other funds are focused on residential or commercial. And so there's so many different types of assets. And so a lot of it comes down to finding out what's the right fit for you and what's going to work with your time frame and your risk tolerance, all of those parameters. Very important to explore and keep in mind.
So like on a fund like yours, you're invested in, I don't know, a lot of notes, let's just say. An investor, do they come in and lock in for a certain amount of time? when, like, if I want to invest in your note fund?
Yeah, note funds will have different time durations. Some are 2 years, 3 years, 5 years, seven. I've seen many different configurations out there, and it's a matter of finding a match for what you want. If you have a longer time horizon, um, then you can look at some of the funds with a longer time frame, and there's no right or wrong answer on that. And there's everything is out there. I mean, I see so many colleagues and different fund managers. They have different business models, different investment thesis, and time frames. So it's just a matter of finding what fits for you.
So, do you have just one fund, or do you do like a kind of like a mutual
We
fund where here, hey, we're in this one is a little bit more aggressive. We're doing seconds. We're doing more high yield type of stuff, which is going to have a little bit higher default rate versus, or do you just do one fund that you buy all these in this one fund?
No, we've had several in over the years, so it varies, and funds will open and close at different times. But it, it's something that what I like is for an investor, you can always find something that matches up nicely for you. And a big part of it is building relationships, get to know different fund managers, different operators, um, so that you can see what options are out there in the marketplace. It's something to always look at and consider, but a lot of times it comes down to one of the most important things that I feel is important in any type of investing. It's building relationships. Building relationships is what gives you access to opportunities and access to being educated, to getting educated and knowing what's going on. There is this huge misconception, I feel, about alternative investing in general. A lot of people go around saying, "Oh, those are country club deals. They're only for the select few." And the reality is, no, they're not. It's just that it takes work. You have to go out and find them. They're not advertised anywhere. You're not going to see that. You have to go out and meet people face to face, go to events, go to conferences, network in person. That's how you meet people and get exposed to deals and opportunities. And that's a skill that will serve anyone very well as an investor. It doesn't matter what type of investment you're interested in.
Yeah, that makes a lot of sense. As I get wiser, I realize that you really need multiple buckets. You need your buckets that have appreciation, depreciation, which is your hard real estate assets, right? But you shouldn't be one dimensional, because there's periods of time that real estate gets soft and there's
Yeah.
problems in the maintenance and repairs, and then there's, I look at investing in like a note fund. It's a passive play for me, right? My job is I have some cash, and those are my employees. I need to put it to work, right? If it's
I
sitting in a
love
bank
that.
account, like, let me go. And I like what you said earlier, where, like, hey, if I have a lot of equity in a property and it's not doing anything, and I can borrow money at 5 or 6 and I can get a 9 or 10, right? I'm
Yeah.
making the margin. And so why would you ever want debt equity? You never would, if you could
Right.
leverage it, right?
Your return on equity you own is zero.
Yeah.
So absolutely, I completely agree. Find ways to put that to use, whether you originate private lending, you originate a hard money loan for an investor that you know and trust. That's great. Or maybe you want to buy a note with that. There's so many different ways to approach that, but I completely agree with you. Look at ways how you can tap your equity that you have in other assets and redeploy that into highest and best use.
I was buying a lot of cheap houses in the Midwest, and that was always in the back of my mind to, like, sell them on terms on owner finance. But those seem like they're way challenging to sell in the secondary market, sell those notes off. So I never did it, but it always intrigued me, because I could buy these houses that would be, the best thing for me would be to sell them on put them on a note. But I found like it seemed like that market's really sloppy and fractured, that it wasn't really a good market to do. What are your thoughts on that?
Yeah, smaller value properties are definitely more challenging for sure. I feel that the sweet spot starts at $150,000 in value and up and going up from there. I mean, yeah, a lot of people have done very well with lower value properties, but
Like
it's a lot of work.
Yeah, like Walter Walford by chance.
I'm familiar. Yeah.
He's like a Jackson, Mississippi. He does really cheap properties and does like that. And but yeah, I think
yeah, you have to know your markets and be really more hands-on. And if that's right for you, that's great. You can do really well with that, but it's definitely not for anyone. And I would not recommend that for someone that's doing it from a long distance for sure.
Yeah. You're going to run into a lot of issues. So you're dealing with that's pretty much the same thing with like the big hard money debt funds that are doing a lot of these fix and flip loans nationally, right? They don't touch anything under 100 grand as far as asset value, because they know it's you're dealing. It's a smaller deal. There's usually more issues.
And it's not worth the costs to set it up. It's right. Even if they pass that on to the borrower, it becomes such a large percentage of the transaction size where it starts to not make sense.
Yeah. So what's your expectations? What's the outlook? We're in 2023. Today is March 2nd. There's a lot of kind of uncertainty in the market. Will this create another opportunity? I mean, back in the day, there was a huge, what was it, like 2010, 9?
Yeah.
Like it was like probably like one of the best times to buy real estate, one of the best times to buy notes, because they were selling things.
It was.
Now it's a lot different. I don't think we're going to see that kind of downturn, because that was in my lifetime, I'm 45 years old, I'd never seen anything like that type of downturn. But do you think there's going to be some opportunities coming up? Are you seeing more now or not yet?
Yeah, absolutely. Definitely seeing more now. One thing that's interesting is that a lot of it gets driven by liquidity. If there's a liquidity crunch, then some of the larger note holders, the institutional guys, they might be forced to sell off assets, and they release large pools into the secondary market. And so a lot of this comes down to liquidity crunches, and we see that all the time. But at a more individual level, those of us in the industry, we buy and sell notes all the time. We might need to recapitalize because we have a deal, a great opportunity, and so go and sell notes. And having those relationships in place, you'll be the one that gets the phone call when a note's getting put up for sale. And people may get the impression that, is there something wrong with this note? Is that why you're selling it? And the answer is no, it's not. The reason is they need capital, liquidity, because there's a new opportunity for them that they can reinvest their capital and get a better rate of return. And so that's what drives a lot of transactions. And so that gives you an overview from the high level with the bigger institutions down to the individual investor as well. So absolutely, in 2023, seeing lots of opportunity coming up.
That's good. Yeah, I would imagine that. So Fred, I think we dove deep, but I think the next step for people that are interested is to probably go get a copy of your book. Where's the best place for them to get your book?
Yeah, thank you. Best place to find the book is on Amazon. The title is The Little Green Book of Note Investing. If you search that on Amazon, it should come right up. And the book provides a great high-level introductory overview of the note investing business, how it works, as well as chapters on how to perform due diligence, how to analyze notes. And we dedicate a good portion of talking about how to do note investing using retirement accounts. and the ins and outs of those transactions as well. So it really gives a nice overview of the business, of the industry, and great resource for anyone that's interested.
Very good. And then if somebody was interested in learning more about your fund or about you, do you have a personal website or your business website they can go to?
Yeah, thank you. I love connecting with investors. If anyone wants to reach out and connect with me, visit my website, which is fredmoskowitz.com. And if you prefer an easier spelling, you can visit giftfromfred.com and it'll route you to my website. And you can request a special report that'll send out about note investing. And if you prefer to text me, you can also do that by texting the keyword money to the number 215-461-4433, and then follow the prompts. I look forward to connecting with you and learning more about what you do.
Very good. Well,
Thank
you so much, Fred. I think this was a great overview of the note business. Obviously, there's a lot to learn. If you're more of a passive investor or you're a busy professional, you know, the investing in a fund probably makes the most sense. But regardless, if you read Fred's book, you can get some insight on operating the business and also like strategies with self-directed vehicles and how to leverage those and grow your wealth. So lots of ways, I think, depending on where you are in your financial journey, because some people might be starting out and they need to be aggressive, and some people have lots of money sitting and not working, like they have these retirement accounts making lousy returns. They can self-direct them, or they're already self-directed. They could put them into something with a little bit higher return, which, we all know the rule of 72. So that's, what everybody's trying to do, right?
Very powerful. Absolutely.
Yeah. Well, thank you so much, Fred. I appreciate
Thank you,
joining.
Beau.
Yeah. Great interview. And it, as always, it's opening my eyes. Like, got to get into the note business. Get my first note would be just a fun thing to do, just to get my feet wet, or invest in a fund.
Excellent.
Thank you so much.
Thank you, Beau.
Hey guys, Beau Eckstein here. If you enjoyed what you saw, please subscribe to this channel. We talk all things financing. I've been in the lending industry for over 20 years, and I'm happy to answer your questions and provide great content.